Welcome to another Maine SBDC webinar. My name is Kelsey Viridin, and I'm with the state office hosted by USM right in Portland. And today we are very lucky to have Maine SBDC at NMDC Center Director and Business Advisor, Brandon McDonald. I've been working on that title for a while. I can finally say it all in one breath. So we're going to be going over navigating the employee retention credits. I was just saying to Brandon, this is one of those sessions that I don't feel like I can answer your questions about. So I will happily encourage you in the chat, but we are thrilled that Brandon is here to explain a rather complex scenario and hopefully make it a little bit more approachable for all of you. Like I said, feel free to put any questions you have in the chat, and if they are not answered along the way, we'll make sure that there's time at the end to answer all of those. If you are not familiar with the Maine SBDC, we are the Small Business Development Centers, and so we're a national federally funded program that provides confidential no cost to you business advising. So we have centers throughout the state and business advisors with each center. And so because of the pandemic, we are still doing a lot of our advising via Zoom, just like this platform. So we're a little less geographically tied to you, and perhaps one of our business advisors has a specialty in your industry or your particular issue. We tend to come to Brandon when we have tax questions and cybersecurity. He's my go-to guy for those two, but all our advisors are pretty well versed and certified to help with just about anything. And if we don't have the answer, we can find someone who does. With Brandon's always got a nice little disclaimer. We can't provide accounting and legal advice, but we can connect you with accountants or lawyers, and we can get you started in the right direction. But we always recommend talking to a professional in those arenas. So we will be kind of hitting on that today. So there's a very easy request advising button on our website so that you can get set up with a business advisor if you're not already. But I will also be sending out a follow-up email this afternoon that will include a link to the recording as well as the slides and all of our contact information. So that'll be easy for you to just request advising there or reach out to Brandon from there as well. Otherwise, I think we're all set to get started today. So I will pass it over to Brandon.
Thank you, Kelsey. So welcome, everyone. Again, we're just going to be talking about the Employee Retention Credit Program. We'll go a little bit deeper into it, but essentially it's a program that was passed through both CARES Act money and the American Rescue Plan Act money. So this is money that is kind of in the past at this point, but what's happening is a lot of individuals didn't realize they were able to get this funding. Some didn't realize they could not necessarily double dip, but receive more than one program worth of grants. This program was actually a payroll tax credit. So it wasn't necessarily a grant at the time, but if you didn't claim it, now it's going to become a grant because it's a refundable tax credit. So we're going to talk a little bit about how the program changed, maybe a little bit of history on it. And again, we'll get to some questions towards the end, but if any of those questions don't get asked or answered in that section, just let us know. Feel free to put it in chat. We usually schedule some time at the end for some questions on these programs. So again, super fast disclaimer. We're not accountants, we're not attorneys. Please talk to whoever you trust to do your payroll or anything like that before you end up doing any kind of amendments, tax amendments going forward. So we'll begin. So what is the ERC, the Employee Retention Credit? So it's a refundable tax credit from the IRS to reimburse up to 70% of full-time employee wages. Now, it was different in 2020. It was a completely different program, and it was actually a little less money if you applied in 2020. I kind of want to shove 2020 aside today, and if you do want to apply for 2020, you should be working with an accountant for that because there's a lot of factors that you have to start putting in for 2020. Now, if you didn't claim this funding on either of your tax returns, the owed amount may be refundable, likely will be refunded. So businesses at the time, they were concerned that they received maybe PPP, shuttered venue grants, or restaurant revitalization funding, and it couldn't be double dipped, right? You can't double dip for the same cost, but you can receive both programs if wages were not paid by one of those programs. So let's say PPP covered only 50% of an employee's salary. The remaining amount could be covered through the ERC. So you will have to have a calculation to take out what you've already received in order to take an ERC on top of that. If your business closed down permanently, you may still be eligible. So as long as you closed down in a certain quarter and kept employees on up to that quarter, even if you closed midway through 2021, you may be eligible for a certain portion of the ERC because, again, this is really just a retroactive refund or a credit to your business. How much can you get? So for 2020, it was capped at $5,000 a year per employee. In 2021, it became a lot more lucrative, right? It was $7,000 per quarter per employee, up to $21,000. The last quarter, that is a super dicey quarter. I don't know if we're going to get a lot of time to talk about it, but that quarter has been reserved for what's called new business or new recovery business startups. So that's going to be a business that began after IRS gives an exact date. It's roughly February of 2020. So just keep that in mind. You will not be able to qualify for that fourth quarter unless you're specifically a recovery startup business. How long do you have to claim the ERC? So because it involves IRS tax amendments, federal law actually gives you a nice kind of buffer on the date. You have up until July of 2023 to retroactively amend any tax returns that were involved for the 2020 iteration. You'll have one extra year, so July of 2024 for the 2021, the much more sizable iteration. So you have plenty of time to start working with an accountant, working with your payroll specialist to get everything together to apply into this program. So we're going to talk about a story of three guys, right? So we've got Greg, Doug, and Bobbert, right? So Greg, he's the owner of a wildly successful magician business. He did not lose significant revenue, but he had Canadian clients or contracts and was impacted by the federal border closure, right? That's any kind of closure, federal designation, state designation, something that impacted the ability for businesses to operate. Can even be on the local level if there was a major event that caused your business to have to temporarily close, temporarily adjust. There are some things that the IRS doesn't recognize. Requirements on masks, that's not something that they recognize. And when grocery stores started putting up the arrows in the stores, they don't recognize that. But they do recognize caps on building requirements. So if you're only allowed to have 50 people in your store, and your store used to be able to handle 70 plus, that is recognized as a impacted closure. And so Doug's a separate story, right? Doug, he tried to pivot his cardio classes to the outdoors, but his class revenue dropped by 20% or more, either in the entire year, or you can take it out per quarter, per 3-month period that was in 2021. And last, there was Bobbert. So Bobbert, he permanently closed his failing restaurant in June of 2021. He had significant revenue loss, and he was either temporarily shut down or impacted due to local, state, and federal mandates. So the majority of businesses that qualify for the ERC, they're going to fall into one of these three stories. You may fall into one of these three stories. You had a federal mandate that impacted you, you had a gross revenue drop, or you permanently closed, but also had something that happened in the process that impacted you. So we're going to give kind of a definition of each of these three stories and how they can prove eligibility to the IRS in order to substantiate their claim for an ERC. So beginning with Greg. This is going to be super reading intensive. I apologize. I hate presentations that have this much reading. So I'm going to try to keep it as simple as possible. So Greg's got 5 employees on payroll. His employees make no less than $40,000 a year. He operated within 40 miles. And again, this is just a scenario, X number of miles of a Canadian border crossing, which was mandated to be closed. He kept all of his employees on payroll throughout 2021. The breakdown of his calculation on what he was eligible for. So the employee retention credit is going to give him 70% of quarterly wages, up to $7,000 per full-time employee per quarter in 2021 for those 3 quarters. So you have the 3 impacted quarters, which was the maximum allowable for Greg. He has $7,000 multiplied by 3 employees multiplied by 3 quarters. That means he ended up seeing over $60,000, comes to the tune of roughly $63,000 for the ERC in 2021. Now, Doug, little different. Doug had 2 payrolled employees. Only one of those 2 were full-time. Did not receive PPP in 2020. He does not need to prove hardship based on anything other than loss. So he doesn't need to prove that a border closed or the state limited him or anything happened in that realm. He just needs to prove that he had revenue loss. So when we talk about revenue loss, it's just straight line gross revenue, sales, whatever you want to call it, the money you take in, not your net profit. So all that needs to happen is your revenue needs to drop by a percentage, in this case, 20%. And in this case, Doug lost 20% of his revenue in both quarters 1 and quarters 3. So the breakdown on Doug gets $7,000 per full-time employee in 2021. That's just one employee for the 2 impacted quarters, Q1 and Q3. So it's 7,000 times 2 quarters. Doug will be eligible for up to $14,000 from the program. Now, Bobbert, due to significant closures and issues that he had with the business, maybe it was staffing, maybe it was inability to move to takeout, he had to close after quarter 2. Now, he had 5 total employees on payroll, but he had turnover. So at one point in quarter 1, there were 3 employees that added up to roughly $7,000 in allowable wages or health benefits, and then 2 employees in quarter 2. He received a PPP for all of his staff, so that's going to impact 2020. Unless he received it in 2021, that's when you guys start talking to the accountant or doing the math and figuring out, what do I have to cut out of this from PPP? So the breakdown on Bobbert, he had $7,000 per employee in 2021 in allowable expenses and wages. He had 2 impacted quarters, but one quarter he had 3 employees, the other quarter he had 2. So you had to add them separately for $21,000 in quarter 1 and $14 in quarter 2 for a total of $35,000. So again, we will likely fall into one of these 3 scenarios where if you had staff turnover, yes, you can still apply into this program. There's a calculator you're going to have to go by where you add in what everyone's staff salaries or wages looked like. And again, $7,000 is the maximum. You're only going to get $7,000 if the employee had roughly $10,000 every quarter, or a minimum of $40,000 in wages, both including wages and qualified health expenses. So their health insurance, what you're paying out of your end. So again, there's a calculator that we're hopeful, I believe it's going to be sent out to you guys along with this proposal. And so presentation, I'm sorry. And so you'll be able to see what we're looking at on our end as well. So none of these stories fit you, and that's maybe okay. So for the purposes of the employee retention credit, we're going to go off of IRS Rule 2021-20. Here's where things get boring, convoluted, and frankly terrible, because this program was not necessarily written with ease in mind. So the IRS will view that a nominal portion of the business operations were either suspended or impacted if either the gross receipts from that portion of the business operation is not less than 10% of the total business's gross receipts. Now, what's a portion of the business operations? We're going to get into that after this. The other option is the hours of service performed by employees in that portion of the business is not less than 10% of all the numbers of service performed by all employees in the employer's business. Let's talk about how nominal portions work, because this is the other way that businesses are able to get into the employee retention credit system. So, for examples, your grocery or retail store. Was an entire department impacted by some kind of shutdown, right? Your deli. Did you have staff on there specifically for a salad bar? Did you have a food service department? Did you have some kind of department that was impacted by the COVID pandemic? Was that department in existence in 2019? That's a key indicator because the IRS wants to see comparisons. They want to see, here's what the deli did in 2019. Here's what the deli did in 2020 or 2021. Was it broken out in a profit or loss statement or QuickBooks or something that you can substantiate to the IRS? Well, yes, I had a department-wide revenue drop. Example 2, did the restaurant, this is going to be a restaurant, did the restaurant take on less staffing due to takeout? Were there less wait staff? Were there less busing staff? Were there less cleaning staff because everything moved to takeout? Did the restaurant break out takeout staffing versus dining room sales or staffing in 2019? Same as the grocery and retail store. You have to break those out separately in separate years so the IRS can see, yep, here's what it was in 19, here's what it was in 20. A portion of your business was impacted. Moving on to another example, that's your gas stations, convenience stores. Did the convenience store element of a otherwise profitable gas station see a 10% drop in either staff hours or revenue versus 2019? And was that portion of the business broken out separately in QuickBooks or some kind of P&L? All others, I think you see where this situation's going. You have to show losses or hourly staffing drops based on a portion of business operations that was broken out in some kind of accounting. That's going to be your profit and loss. That's going to be your QuickBooks. That's going to be however you do your accounting, as long as there's a benchmark, your 2019 versus your 2020 or your 2021. Does it correlate? Can you show that the deli, the convenience store, this portion subset of your business dropped by 10% either in staffing or revenue going forward? So the nominal revenue test, right? So we try to break this out into some charts. And again, I know how convoluted this gets. This is unfortunately how it goes when you're working with the IRS. So the nominal revenue test. Let's say that in Q1, you did $45,000 of sales in 2019, but in 2021, you did 40. Q2, you also had maybe a 4% drop. That's not going to play in anything. Q3, we can see a sizable drop. In Q4, nothing happened. Same on the nominal hours test. So this is hours worked in that department. It's clear that Q1 and Q2 have some kind of a shift, and then Q3 and Q4, everything picks back up. What does this mean? Essentially, it means that employees retained in Q1 and Q3 of your nominal revenue test, those will pass the sniff test of the IRS being able to say, yeah, that seems like there's some losses here. There's a correlation of losses going back to 2019. So they'd be more willing to entertain an ERC request from those businesses rather than something that can't show that correlation of nominal revenue losses. Same on the hours test. So Q1 and 2, they're able to show that clearly departments were understaffed, could not find staffing, had to drop out completely in the case of maybe a salad bar attendant at a deli. You're probably not going to have them because self-service salad bars weren't really a thing. Now, if you move that person into the same role at the deli, maybe you went from having 2 deli staff members to 3. You move the salad bar attendant on the deli staff. If it was still categorized as deli and you didn't separate out the salad bar, that's going to make things a little bit of a tougher situation because they're not going to see that nominal hour drop. You have to show, again, on paper that either the hours dropped or the revenue dropped in order to qualify under this subset, which again, is a lot more convoluted than the original 3 stories that we talked about. So here's the bottom line, right? The IRS doesn't want a gotcha moment, right? They don't want to come back and ask for the ERTC back. They've actually written a lot of this verbiage to be intentionally vague. They want to get this money out to those who absolutely needed it. And at the time, a lot of corporations, bigger businesses have already taken advantage of this funding. It's really the smaller businesses that didn't have the on-staff accountants to help them get into this funding. The key is have the records to back up your claim. That's what we're talking about today. Have records from QuickBooks, internal profit and loss statements, logs, your own your own payroll quarterly tax returns can help. Now, the IRS is not going to ask for this information up front. You should always be prepared, right? In this case, the IRS is really just looking for an amendment to be done on your tax return, and everything else is just going to be something that you're going to keep on hand. So here's the part that a lot are worried about. How do I apply? So it's really simple and really difficult. And the reason it's really difficult is because of how convoluted the process gets and how subjective it feels on the nominal side of things. The IRS has done a good job in the past couple of months on giving us a ruling on the 10% rule, right? The magic 10% nominal rule. So if you don't fit into the 20% revenue drop, you have a second subset you can get into. But if you don't fit into any of those, it becomes very difficult to prove your business had some kind of impact. Whenever you're in doubt, if any of this seems like gibberish, it's time to talk to your accountant or payroll provider. A lot of accountants are well versed in this program. They're probably going to talk about how convoluted this was in 2020 and the changes that happened up until this year. They're also understandably cautious because of the rule changes. The IRS has put out, at this point, probably 5 or 6 different rule changes, which is just crazy for a program involving the federal government's IRS branch, right? You do one thing on one quarter, and the next quarter, everything changes. Payroll providers are going to have more experience in the employee retention credit realm. You should really utilize that plethora of expertise. Now, do you think you can do it solo? Please only consider doing this if you understand what an IRS Form 941 is. We're not accountants. We are just telling you these forms exist. You should prepare documentation. You'll utilize a calculator like the one we're going to send out to back up your calculations of, I had X number of employees in this quarter. Here's what they made. Here's what their health insurance was. Here is what you are owed for the employee retention credit. When it comes to the IRS, if you're in doubt, always round down. If you feel like 2020 would be a tough year because of grants that you received, maybe worry a little bit more about 2021. 2020, unless you have sizable amounts of employees, $5,000 is a lot of money. But if you're not 100% sure that you're eligible, maybe that's a tough year to put on paper. Create your narrative. The IRS is going to reserve the right to audit these. They don't do it initially, but they reserve the right to audit it. So if you've been truthful, you have nothing to worry about. You should always have your story together. The Canadian border closed and I lost some of my contracts, and that's why things went down 10%. The salad bar had to close, and that's why I had to cut hours. That's why that's down 10%. They're going to not only ask for substantiation, but tell me why this happened in your business. We just want to know your story. As long as you have that story together, the IRS just wants to know this money is going to businesses that in good faith kept on as many employees as they could, but suffered some kind of pandemic-related loss. After you get everything together, you're going to have an IRS Form 941X. That's going to be an amendment to the 941 quarterly returns. You're going to do this for every quarter that you believe you are owed. We cannot help you fill out this form. We can only let you know that it exists. If you are familiar and already do your IRS Form 941s, this may be a simple form for you to amend. If you don't know what I'm talking about right now, please talk to someone who does. You got to find someone who understands the 941s, because that's going to be where this program really originates. It's going to be just a simple amendment. That's where it gets simple. You amend the form and send it in. That's the end of it. The convoluted, difficult process comes with the back end, how much paperwork and how much documentation, and how do you back up? If you're in that first pot of money, it's a heck of a lot easier. Those 3 stories of Doug, Greg, Bobbert, those guys are going to have the easier time of applying into this funding rather than the nominals. The nominals are going to have to prove that they had that loss. So are nonprofits eligible? We're going to get a couple of questions in. Yes, nonprofits are eligible. Is a state or local government eligible? I know I saw some states and local governments on this webinar. Unfortunately, no. and also instrumentalities of a state or local government are not eligible. Now, what the heck does that mean? And there's so many checklists that the IRS gives. And then they say, if you say yes to the questions that disqualify you, you might still be eligible. So it's a case-by-case basis. It's one of those things that I really don't want to advise too much on, but essentially it is case by case. And if it's a fire department that does all of their budgeting without a penny from the state or local government, then maybe that's something that does qualify into this. Sole proprietors, are they eligible? My favorite term in ERC. Yes, right? So maybe. It depends if they have payroll involved. So the owner itself, if they take a deduction basically just out of the business, they take their net profit out of the business, they're likely not eligible because they aren't paying into FICA or any kind of payroll taxes. That's really the key of this, is payroll. If you have payroll taxes that are paid on each employee and they're on those quarterly tax forms, you may be eligible for this. And even the owner, if they are treated as an employee, taking payroll quarterly tax returns income, then they could be eligible. And that's where I suggest it's time for you to start looking into this. What can you use the money for? Anything, literally, within legal reason, right? So this is just a refund. It's a refund to the business. So what happens here is this money just goes back in your pocket. You already paid this in. Remember, the $7,000 per employee was, at the time, supposed to be given or credited at tax time. So business has already received this back. The money that you're going to be getting from this is your use as an owner. You are not necessarily required to put it back into the business, but as the SBDC, that's what we want to see. So that's the only advice I'm going to give you, is please keep it in your business. Please use it to help you weather the pandemic and come out of this pandemic on top. So is the ERC taxable income? Nope. It's a tax refund, actually. So the money you're getting from this is not going to be taxable income. However, there's an asterisk on that. It could bring down your payroll tax business lines. And if it does that, what does that do to what you owe in taxes? Is it going to get things wonky on your net profit? That's a tax accountant question. Are you a new business? Did you begin after February of 2020? It's time to talk to your accountant, right? There's eligibility for you. Yes, you can get into the program. There's an expanded quarter 4 that you can get into. And I do encourage you to get in touch with your accountant to find out how you can get into that as a recovery startup business. Now, one question we didn't put on here, but we have received is, what if my accountant doesn't want to work with this? And that's totally fine. The unfortunate truth is, up north, we've got accountants who just say, absolutely not. We got to stay hands off of this. There are specifically employee retention credit accountants that only work with this program. The only thing I want to caution you about, when you work with, they call them the fine tech companies, right? Your online ERC, send in a form, they'll call you once, and then you'll end up getting a check. I just want to caution you where the burden of proof does not lie on that company. They're going to send you a DocuSign, and as long as you DocuSign it, you're going to be responsible for the information you gave to the IRS. They're not going to give you the same caution that I'm going to give you. They're going to say, we'll take 5 or 10% off the top of whatever you're receiving, and I don't care what you sign it. The liability falls off of them, and you don't get good representation. That's the unfortunate truth of working with online DocuSign, one phone call companies, is they're not going to do the homework to find out if you truly do qualify. And here's the concern. If you don't have the homework done and the IRS calls, you may be liable to pay all the ERC back, maybe even with penalties if they find out that it was fraudulent. So just keep it in mind. If you're going to go online to apply for this, totally, it's up to your judgment. So if there's any questions we haven't answered at this point, I just want to let you guys know what we can't answer. Can't answer a legal question. I can't tell you if you're going to get sued or anything like that on a program like this. Can you help me file or amend my 941X? We can't. In Maine SBDC, we cannot amend or file any tax returns on your behalf. really we got to tiptoe around guiding you on what to put on those tax returns. So that's why it's going to be important for you to get in touch with a good tax accountant. And what's Bobbert doing with his life now? I think we got to leave that one to your imagination, right? So for everything else, please leave a comment in the chat. I see there's a couple in there. We're going to try our best to answer them going forward. And again, anything that I can't answer, we'll make sure that we get an accountant, or make sure that you can get an accountant or a payroll specialist, because they might be the ones already doing your quarterly tax filings anyway. So thanks for your time today. Hope this helps start this journey, because it is a journey. It's going to take some time to get this money in your hands. The IRS could take up to 12 months once they get your amendment. So just keep that in mind. This is not necessarily going to be quick, but it is going to be what I'd hope is a lucrative opportunity for your business. Now, like Kelsey said earlier, if you're looking for more assistance with your business, you'll visit Maine SBDC.org. You'll click Request Advising, and you're going to get in touch with your local, free, confidential business advisor today. And if you prefer emailing me, you can contact me at any time. Again, I can't answer questions that I already said I can't answer in this webinar. But if you have a question you don't feel comfortable asking in the chat, if it's a little bit more personal to your business, or if it's something that you feel could take up some time, you can feel free to send me an email at bmcdonald@nmdc.org. So for now, I'm going to stop sharing, and we are going to get on to questions.
Awesome. And yes, I'll make sure your email is included in my follow-up email, so people don't have to go searching for any of that information. We did get a couple of questions. So Jacqueline first said, my business transitioned from a sole prop to a new entity, S Corp, in Q3 of 2021, and I put myself on payroll rather than taking an owner's draw, as well as taking on another W-2 employee. Can I apply for this credit for the Q4 of 2021 time period, as we became a new entity?
So, Jacqueline, were you, and I guess this would be a secondary question, but you'd have to show that when your business just started up, right? Because we're going to say you just started during that period, you'd have to prove that there was a pretty egregious thing holding back your business. So if we can show that on paper, I think that your accountant might be able to figure something out. So on paper, I'd have to leave that to an accountant, Jacqueline. And that's just really, that's going to become super subjective on what the IRS is going to accept for documentation to show that you were impacted by this.
And Jacqueline, feel free to add in if you have for follow-up information with that. She's saying we were originally an event-based business that needed to pivot to wholesale as catering crashed. So
right, that on paper, I mean, that feels like a slam dunk. And theoretically, Jacqueline, I don't know if you had employees on the original business, but if you did, the original business, if it had payrolled employees, could also be eligible for a separate ERC on the previous quarters. The new organization could fit. Again, that's going to be an accountant question.
All right. She's saying we did not, only myself as a sole prop taking an owner's draw. So glad we could help with that. Two questions from Rebecca. Is there any information for a company that used WorkShare from the state of Maine? And then second question is there any information for a company that used, oh, no, she just sent it to me privately and also to the group, so everybody could read it.
So, Rebecca, I guess I'd need to know what you're looking, are you looking for documentation of WorkShare? That's probably going to fall more under Maine DOL. But WorkShare, since it's state money, the IRS, again, this is where it gets subjective and convoluted. They don't necessarily bring up state relief. They bring up federal relief. They don't want to see the PPP, Restaurant Recovery Fund, shuttered venues grants, idle advance, if that was earmarked specifically for salaries. Those are the things they don't want to see. Where it comes to Maine WorkShare programs, any kind of unemployment compensation, that's a little bit challenging. Can you take the credit because the state paid half wages? So yes, the difference between the wages is what you may be eligible for. So again, if your accountant thinks that this is going to be an issue on the state side, then they'll apply for the difference in wages that you'd be eligible for, and then take out half on the work share. So whatever work share paid. So you will get the difference between for 2020. And in 2021, as long as there was still an issue going on, you would be eligible under the new calculation, that's $7,000 per employee per affected, impacted quarter.
All right. And again, Rebecca, if you have additional information, feel free to pop it in there. And then Libby is asking, will the credit cause the Schedule C to also be amended?
Yeah, so that's kind of what I was talking about at the end, is the second you start bringing down how much you actually spent on wages, it can throw off what your business return looks like. So chances are you might also have a secondary amendment on your business tax return. So again, this is where you really got to dig in with your payroll provider and your accountant. And at the end of the day, $7,000 an employee per quarter, it might be worth paying, a retainer fee to your accountant just to get this through, because again, you're going to have more than just the 941X in some cases to really qualify for this money.
All right. Well, I don't see any other questions, but if anyone has them, feel free to keep putting them in the chat. Kristen has a question. I missed it the first few minutes, but I do our payroll through QuickBooks in-house. Do I understand the 940? So they do understand the 941 mostly. Is there paperwork to complete separate for the ERC?
No, it is just an amended return, which is just crazy to me, because you'd feel with all these federal programs, there'd be some kind of application process. But again, where this really wasn't a grant as much as just a tax credit, right? It's a tax write-off that's refundable. So it's just going to be the amended 941X. And if that impacts your business tax return in any way, shape, or form, you may have to amend that as well.
All right. Thanks. Well, thank you, Brandon, very much, because this is complex and it's nice when someone can explain it in a way that makes it seem a little less complex, even though it is. So thank you everyone for coming. We did record the session, so if you have anything you need to rewind to, that will all be available, as well as the slides, which are all clickable links. We're getting lots of thank yous in the chat. Other business advisors are here. They're finding it helpful. So a real team effort today all around, with Brandon doing the majority of the heavy lifting. But yeah, so everyone's saying thank you. This helps tremendously. Amazing. We love to hear. You don't usually get those descriptive words when talking about taxes. So we'll take all the compliments.
Thank you, everyone. That's wonderful. Yeah, taxes, this whole program, very, very tough program, but I'm hoping this gave a little bit of guidance. Again, I wish I could prepare everyone's ERC calculations and get those in, but unfortunately we're kind of bound to this. So that's why we've got to push it to whoever does your taxes, or if you're comfortable doing it in-house, go for it.
There you go. And definitely, if you have any questions in the future, feel free to respond to any email that you've gotten from me. It'll end up in the same place, and I can connect you with Brandon if needed. But otherwise, keep an eye out for my follow-up email later this afternoon, and hopefully we'll see you all at the next session.
Thank you, everyone.
All right. Have a good afternoon.